Hello, everyone. It's Kim Butler, and I'm so excited to be here today with Jimmy Vreeland and Bob Scott of Joint Ops Properties. We have always believed that investing in bridge loans is a great way to get cash flow. And cash flow is something that a lot of investors are not trained to get. The typical stock market environment is not going to create monthly or quarterly income. And so when you're looking to have a lump sum of cash create monthly or quarterly income, one of the best things to do in my mind is something called a bridge loan investment. And to me, what that means is that you lend money to a real estate deal that then turns around and provides you monthly or quarterly income. And that at its simplicity works really, really well. The joint ops guys have an additional twist to that. And one of the things that we're always looking for in our investments are win-win environments where both the buyer and the seller win. And sometimes you can even get a win-win-win environment where there's a third party that's benefiting as well. And this is what the joint ops guys have done. They enable families in St. Louis, Missouri, to get into a home as a lease-to-own renter, which then will end up owning the home. And so that's the third win. And one of the things I love about their company is if you go to their offices in St. Louis, they have gobs of pictures all along the walls, many, many, many pictures of families that they have helped. So here, you as the investor have an opportunity to get a great cash flowing investment, and you're helping a family get into a home that they might not otherwise be able to do. So let's dig in and learn a little bit more about Jimmy Vreeland, Bob Scott, and the joint ops properties that are available in St. Louis for investors all across the country. Welcome, guys.
Thank you. Kim. Thanks for that great introduction. Appreciate it.
Absolutely. So tell us a little bit about how you guys do this.
Yeah, so real quick, a little bit about our background. Jimmy and I have been in business together for a little over 2 years. We both kind of read Rich Dad, Poor Dad, I think back in 2006, and both got bit by the real estate bug then. We're both Service Academy graduates. Jimmy went to West Point, I went to Air Force. And so connecting over Rich Dad, Poor Dad, real estate, and our similar backgrounds.
I have some Austrian economics.
Yeah, big Austrian economic fans. We started saying, hey, let's jump into business together. So we've pretty much been consistently buying close to 3 to 7 single family residences in St. Louis, Missouri for close to the last 2 years. And basically how our system works is we identify distressed properties, and we can pick up these properties for anywhere between 30 to 50 cents on the dollar. So these are homes that are foreclosures, short sales, estate deals. And for every deal that we decide to pull the trigger on, we're probably evaluating another 20 properties. So we have a very stringent evaluation process for us to say, yes, we want to buy this property. That protects us as the investors. That's how we make our money, and also protects your potential investors. And that's kind of the safety lever when you're looking at real estate. It all starts with a deal. You have to buy at a discount. We never pay retail. And as you mentioned, we have a unique exit strategy. We do entirely lease to own, sometimes called lease option or rent to own. And the reason we do this model is because basically since the last real estate crash, mortgage fallout, subprime crisis, there's estimates that about 80% of the total buyer pool currently can't qualify for a conventional mortgage. So of the people who have a desire to be homeowners, who have stable income, steady jobs, they have a down payment that they can afford the house, only 20% of those people can actually get a home loan through a lender. And it's really a shame. So we started to offer this model to kind of meet that demand of the 80% and say, look, a normal bank won't work with you, but we will. Because nowadays, a minor ticky-tack issue on a credit report can sink somebody's credit score.
Yep.
There's all types of things. Credit is a big issue, but it's also folks who are self-employed and need 2 years tax returns if they're new in business. A lot of people who might just be new to St. Louis and have a new job, and they don't have 6 months on their current job, even though if they're coming from somewhere else where they made really good money the past 2 years, they still won't be able to get qualified. So,
and it also really works well for contractors. There's no incentive for them to buy retail when they can put the sweat equity into the house and build the house exactly the way they want it.
Right.
So a lot of contractors are actually looking for these deals because they know they can add value to the property.
Sure. And the thing that I want to add is that you're making the decision on the buy side. So your profit is made when you buy the property, and you already know how it's going to play out. And then furthermore, your investment is not relying on that home appreciating substantially for you to get results. Now, while I'm sure that happens some, and because you're buying at such a discount, you're going to see some increase in value, but this is a cash flowing deal. Talk to us a little bit about that.
I got out of the Army the day Bear Stearns went out of business. So at the back of my mind, there's always 2008. And from what we've studied and the people we've known who've been around this game since then, the people who got crushed were people who were appreciation buyers.
Right.
That they looked at a property like, it'll be worth X in 3 years. I got to have it, even though it was not going to cash flow every month.
Right.
So we buy strictly for cash flow. And if appreciation happens, it's a nice cherry on top.
Super.
We have a few mottos around here, and one of them is you can't eat equity. So we don't really care what it says on the balance sheet.
I love that. That needs to be restated. You can't eat equity. I ask clients all the time, what is your equity doing for you? And I've yet to get a good answer. So that's great.
And I get pretty bored when I hear about someone's net worth or the net worth of a portfolio. Who cares?
Right.
How much cash does it kick off every month?
Yep.
Exactly. So we mentioned a few of the benefits to our tenant buyers who are in our program, but from a real estate investor, the rent-to-own model really benefits us as well. One, we're getting somebody who has an ownership mentality. These are not like regular tenants. They want to buy. They're putting a non-refundable option deposit up front when they move into the home, which is typically 3 to 5% of the value of the house. So we're getting a lot more skin in the game. That option deposit is really the glue that makes the whole thing work. That's their commitment. And then when they go to exercise the option, that counts towards the purchase price. So it's pretty much like a down payment when they do go and get all their finances in order. The other great thing about it is we basically eliminated all the maintenance and management costs because our tenant buyer is responsible for those. And we say, look, within 2 years, this house is going to be yours. We just, haven't transferred title over to you. So this is kind of like training wheels to understand what it takes to maintain a home and be a homeowner without necessarily taking on all the risk quite yet until they actually do get on title.
And then that also protects our investors because we're not paying a $50,000 a year salary to a maintenance coordinator, and we're not spending all that money on human labor for the ticky-tack maintenance. So that cash sits in our bank as a reserve to pay interest to the private lenders.
Right. And nothing like skin in the game to help people operate at their highest.
Yeah, right. Exactly. So how would this work from a private money perspective? One thing that is a big differentiator from us versus some other companies is we never pool funds. So there's one investor on one property and one loan. Every investor gets a first position lien against the property. So we cannot sell it. We cannot refinance it. We can't do anything with this house without paying our investor back. And that is really on the investment side, the glue that makes the deal work. This is protecting you as the investor from potential downsides, because worst case scenario, you still have brick and mortar. And I don't care where you're at in the country, that'll always be worth something.
Right.
So the note kind of outlines the terms of the agreement, and then the deed of trust is what is recorded against the title in Missouri. Some states are mortgage states and others are deed of trust states. Missouri is obviously a deed of trust state. The other thing is that investors are named as the additionally insured on the hazard policy. So worst case scenario, if the house burnt down, a freak accident, the investor still would recoup their entire investment.
Fabulous.
And we have had one half of a house burned down. And just to get to worst case scenarios right now, that investor still got his interest that quarter, and it was insured, and we just rebuilt that part of the house.
Fabulous. Yep. That's a super critical third element there. You know, people often ask, well, is this money guaranteed? And I like to say, no, it's not guaranteed. It's secured, and it's secured by a deed of trust on a real piece of property, but not one that they're going to have to go track down. If something goes wrong, that's why you guys are there. You've got boots on the ground in a literal way. And if you need to go help get the house rebuilt, collect on the insurance, pull a renter out that's maybe not meeting the standards, which doesn't happen a lot, but I still realize it does because it's human beings we're dealing with. Mm-hmm. You guys are there to deal with that.
I mean, we kind of look at it as a Dan Sullivan unique ability model. Our unique ability is managing these houses, finding these houses, and managing their system. But our lenders are out in their jobs exercising their unique ability.
Love it.
Their reserved capital, we're just able to put it to work for them.
Yeah.
Absolutely. And just to tie in what people do with the cash flow as we move forward, a lot of our investors will use that cash flow to pay their life insurance premiums. And I know you guys are big believers and users of whole life also. So it's nice when we're all talking the same game, all using the same types of systems and products and strategies. So whole life may be the product that we buy, real estate may be the product that we buy, but the strategy is using careful leverage and using cash flow to really elevate up and multiply up what those dollars are doing.
Exactly.
And Nelson Nash would like this. We also completely eliminate the banks from the system.
That's correct. Yes.
The buyer doesn't need underwriters. We don't need underwriters. And then the investor doesn't need to pay their fees to some bank or Wall Street company.
Yeah,
that's right. Love it.
We've essentially cut out the middleman. And that is really the position that the lenders are in. They're acting just like the bank. So no matter if the property is occupied, if it's vacant, if we do have to evict a tenant, the investor is still going to get their payment every month or quarter, however they've decided to receive it. So we handle everything on our end. And
love it.
The last part is that all funds are handled by a third-party title company. The properties, the title company is basically verifying that the property has marketable title. They're giving a lender a title insurance policy, so if anything pops up later, they can recoup their investment that way as well.
Fabulous. And when our lenders, our clients that are the investors, are sending the money in, that's going straight to that title company as well on a specific property, not to just some generic title company.
Correct. Exactly.
And if they lend $50,000, $50,000 starts collecting interest. We're not taking fees. You give us 50 will collect interest.
Fabulous.
Yeah. So a little bit about our track record. As we mentioned, Jimmy and I have both been investing in real estate since about 2006. We've done probably combined, I'd say, close to 200 deals at this point. I was a civil engineer in the Air Force before this, so I had a lot of construction experience. I was managing projects. And right now we have a little over 125 units, single-family residences in St. Louis, Missouri. And we have 0 defaults out of 150 private money loans.
That's great. Congrats.
Thank you.
Well, I mean, and that's kind of the sword of Damocles over our head. The first time we default on anyone, game's over. So we have a lot of incentive to never, ever default.
Yep. It's a nice word to use.
Yeah. And St. Louis is a great cash flow market, and it is very easy to make these numbers work. I mean, if you're out and investing in California or New York or Florida, it's tough to cash flow properties. But
right.
When we have the analysis that we have up front on these deals, it's very easy to get that 0 default rate. And so the big thing is, what's in it for you as investors. We pay our investors 8 to 10% interest, and as you mentioned earlier, Kim, you could get monthly interest payments or elect to receive it quarterly. Kind of depends on what you want, and if you want to be cashing those smaller checks or whatever your income needs are. And each investment is secured by one cash flowing property in St. Louis area. Our typical investment is anywhere between probably $25,000 on the low end to as high as $60,000, $70,000. And that will get a 2 to 3 bedroom, sometimes 4 bedroom house, anywhere between 1,000 square feet to 2,500 square feet that will rent out on a monthly basis from probably $700 to $1,500 per month.
People are always looking for the bottom line up front. So they're going to get paid 8 to 10%. Generally, most people aren't quarterly, especially with the IRA. If it comes from self-directed IRAs, it's just a lot simpler to pay quarterly. And, one and only name on the title and deed of trust.
And how is the
deed of trust? Sorry.
How is the interest determined? So you say 8 to 10. Walk me through that.
Generally, it's the amount. People who lend us more get more interest.
Okay. That works. And can be IRA money or cash money.
Right.
And the time frame, we may have covered it, but let's just hit it again so people are clear. It's 1 to 2 years, or it's at 2 years?
It's 2 years.
Okay. So this money needs to be committed for a 2-year time frame. You're looking at 8 to 10% paid quarterly or monthly, and then you get all your principal back at the end of the 2 years.
Right. And the reason it's 2 years is because we sign 2-year options with the tenant.
Okay. And what happens if the tenant's not able to refinance and get a typical mortgage?
So if they're a good tenant and they've been current for 24 months, we'll just owner finance them and become the bank. We also may sell it off to another investor as a turnkey investment. We could refinance them out with another private lender, or worst case scenarios, we'd have to go to a commercial bank and refinance them out.
Okay.
And we do keep relationships with commercial banks in St. Louis as for that safety valve.
Sure.
Yeah.
So if one of our investors absolutely has to get their money back, you've got some resources to help make that happen.
Yeah.
And if one of our investors wants to stay in the deal in some way, you have some opportunities in that realm as well.
Yeah. 90%, because we started on 6-month notes. So we were really have to turn the money quickly, but I'd say 90% of our investors are just like roll it for another 6 months, and then became roll it for another year, and then it's like roll it for 2 years.
Right.
Yeah, because once you've done that due diligence up front and you've picked a house and you're okay with it, and you're getting an above market rate of return, and as low risk and least volatile way possible, why put your money anywhere else, really?
Right. And why force yourself into making a new decision every couple of years if you don't have to?
Yeah.
Super. Nice to have the flexibility, though, for those that want to just put their toe in the water, so to speak.
And if you're new to real estate, we always recommend start with bridge lending.
Excellent. I agree.
That's how I started. My second bridge loan was to Bob. And I was like, these monthly checks are nice. I should do more of this.
Yep. And I recommend that all the time. Go slow, start small, do one deal. Get your confidence up from those monthly or quarterly checks, and then go forward and do some additional deals once your confidence is there by proof, not by anything you guys or me are saying.
This is the easiest way to win while you're learning.
Yep.
Because,
well said.
I mean, if your first year, if you want to become a landlord, and if you get an 8% return, you are a hero.
Right.
So here's a quick overview of the process. Like you mentioned, once you've picked out a property, we're basically going to send a prospectus to you and give you our reasoning why we think this is a good deal. We've done a combined 200 deals at this point. I've probably walked close to 1,000 homes. So basically, once you give the green light as an investor, you'd send the money directly to the title company, and the title companies we're going to record that deed of trust. And then we're going to take that money and we're going to acquire the property, and we're also going to have some repair money to put into the house to improve the market value. And then we're going to plug it into our marketing system, and we are going to find a lease option tenant buyer. We've been doing the lease option model for about 2.5 years, so we have a huge buyers list at this point. Almost 10,000 emails and 15,000 phone numbers of people who want to rent to own or own or finance property in St. Louis at this point.
And Bob's unique ability is the marketing system to the tenants.
Okay, fabulous. That's a great resource.
Yeah, it really helps, and our business has really started building steam, and we can lower those holding costs and lower risk when we can fill the properties quickly.
Right.
And then basically from that point on, either every month or every quarter, investors going to receive their check, and then at the end of the period, as we mentioned, you can refinance, or you can let the money ride, or we are always buying more property, so you can put the money into another property at that point.
Fabulous.
And here's a few example projects. As you can tell, these are nice homes. I think this was probably a 1,400 square foot property, 3 beds, 2 bath. We purchased this property and we're all in with an investor for $30,000. The investor received 8% return on their money, and the market value of this house was $65,000. So that's one of the keys here as an investor is you have to make sure whoever you're lending money to is buying this deal at a discount, because as an investor, that's your safety valve. So this market value is today's market price. It's not, what is this thing going to be worth in 2 years or 5 years? You need to make sure there's equity today, because worst case scenario, if another 2008 happens and, the market drops 25%, the investor is still covered here because they've only put $30,000 into this property. So after that, we ended up signing a lease option agreement with our tenant buyer of $62,500, and we got a $3,000 option deposit and $900 per month rent. And the $900 per month is another check on the safety of the deal, because that's kind of how we make our money is the spread we pay our investors and what we're collecting in rent, plus all our admin expenses, taxes, and insurance. But
plus our team of 5.
Yeah,
so
exactly.
Yeah.
And then here's another project in Mohan. This one's a little bit nicer. This was a 4-bed, 2.5 bath house on with 2,500 square feet on a little over an acre. I know that probably sounds crazy to most people in the country that we bought this thing for $75,000. But that's what you got to do, and those are kind of the deals that are available in St. Louis. As I mentioned, It's one of the best cash flow markets in the country. This home, within a month of us buying it, appraised out $155,000. So again, the investors right around a 50% loan to value. You never want to be in for more than probably about 70% loan to value on these type of deals. Most of ours, because St. Louis still isn't as hot as other areas in the country, we're going to be in for 50 to 65 cents on the dollar.
Fabulous.
The tenant buyer signed an option agreement for $140,000, and they put $7,800 down on this property. So this is a great tenant. Anybody who can put $8,000 to move into a home and also be paying $1,500 per month rent is a great tenant. We never have to worry about these people. We don't hear anything from them. The rent check shows up. And on this deal, most of our properties between tax and insurance have probably $150 to $200 per month in tax and insurance. This one's a little bit higher because it's a larger property. So our expenses are $260 per month on this. But here's the big kicker is we have $80,000 of equity in this deal to protect the private lender's investment. So, the value of this home could drop in half, and the investor is still covered. And they're still going to be getting this one is actually a 10% yield just because it's a little bit larger investment. But they're still going to get that interest rate because it's coming from the cash flow from the rents that are received from the property.
Fabulous. Great examples.
And this is how we make our money is, again, like I said, that spread between what we collect in rent and what we pay out in all of our expenses. And then we obviously have a capital gain on the back end when the tenant buyer does exercise their option. And why do properties in St. Louis? Jimmy and I were born and raised here, but we talk all the time, like even if we weren't from here, we would still be buying properties here. We've traveled around all over the country. We've been down to Memphis, Jacksonville, and there's very few markets that will cash flow as well as St. Louis. We have
like if you're on the East Coast and you want $1,000 of rent, you're going to have to spend close to $200,000.
Right.
Yeah.
So we have seen an influx of money from either coast coming into the Midwest. Kansas City's kind of the same way.
Exactly.
And then we don't invest in Illinois because Madison County is one of the most litigious counties in the country.
Interesting. Is that the one that's right across the river?
Yep.
Okay.
And the taxes are higher in Illinois, and the landlord laws are not very friendly.
Okay. Smart.
So
that's why we stay on this side of the Mississippi.
Okay.
Yeah. And the other thing is if you look back through kind of what happened to rents after the last real estate crash, rents were very steady. And in some areas, some neighborhoods, they actually upticked. So that's another reason that you want to be a cash flow investor, is that if the market does crash, you can still depend on those rent checks coming in. And if anything, there's more of a demand for lease option and rent to own properties in that environment.
Right.
And we did kind of design the whole business around what happens in the next crash. And the way we figure the next crash, banks are going to lock up. So no one's going to be able to buy a house. So we're going to be the only people in town still extending that to people.
Right.
And then also, since the more private money we get and the less bank loans we take, when there's liquidity crunch with the banks, if there's cash calls, we're going to kind of walk away from the banks being like, it's not our issue. Everything with us is private money.
Okay. Love it.
Why we like private money to protect ourselves.
Absolutely.
Okay. So why this investment? I think most of people you deal with, Kim, aren't that big a fan of economic regulation.
Right.
So I can't stand it after being a government employee. So, if you're going to go invest on Wall Street, you're going to pay a lot for compliance. You're going to pay a lot of fees, and you're going to pay a lot for their lawyers. So we have to pay our lawyers. We don't charge that to the investor. Even at market all-time highs, if you're in your 401k or your mutual fund, you're a hero if you're getting 8%, and that is before taxes. They are happening in Europe, these negative interest rates. So, our mindset. We don't really feel that banks are a good place to store dry powder. So we like to store it either in life insurance or inside a house. We've raised close to $3 million. It's all because we've raised it probably $50,000 at a time too. And it's all these people moving their self-directed IRAs away from the market.
Right.
We get a higher rate of return, and like we've said before, it's actually backed by an asset. So the next market crash, that piece of paper, that stock which is valueless, there's still going to be a kitchen and bathrooms. People still need to eat and shower and sleep in our houses.
Right.
And if you actually look at like replacement costs, what would it cost to rebuild these homes that we're buying to buy the land and to hire the contractors and pay for the bricks and the drywall, everything else. Most of these homes, let's say a 1,200 square foot house, it's going to, on the low end, probably cost you $100 per square foot to rebuild it. So just the materials alone is going to be worth $120,000. And we're buying these things for $40,000, $50,000, $60,000. So again, you're very well protected as the investor in these homes.
Yep. It's an amazing model.
So here's our contact information. This is Jimmy's direct number. You can reach him at 314-799-2247 or email us at joinoutproperties@gmail.com. You can check out joinoutproperties.com, and we also have a YouTube channel. We do a lot of walkthrough videos, so you can actually see the types of homes we're doing. They're very nice neighborhoods. These are blue-collar homes, really quality families in all of our properties.
And we also do videos popping off about how bad qualified plans are and how good life insurance is. I still have a lot of angst from when I was a W-2 employee, so YouTube helps me get rid of it.
I love it. Well, it enables people to check you out, and that gives people confidence. And my message to our investors is, as always, go slow, start small. So pick one deal, do 30, 40, 50,000, whatever it takes. Start getting your income, your cash flow. That's the measuring stick for success. And once you have some of that, then you'll gain confidence. And whether it's cash money or self-directed IRA money that might be rolled over from a 401k, or from an old IRA somewhere. This is an environment where you can count on the cash flow. And I love the security that is provided by this investment. An actual first deed of trust specifically in your name to back up the value of that loan in a very conservative environment. So the term is loan to value, and these properties are anywhere between 50 and 65% loan to value ratio, meaning they're worth a lot more than what you're lending. But again, we're not even relying on appreciation. We're focused on cash flow. You're going to get that cash flow. And this consistent cash flow can then go on and do good things for your family, whether it's giving you the income that you're looking for to actually spend, or potentially giving you the income to leverage up into your next life insurance premium, your paid up addition money, or any other environment that requires that consistent cash flow. So I really encourage you to reach out to Jimmy. You're welcome to look at the information on the YouTube, see the various sample properties that they have. If you're in the Midwest, you can even go into their offices, see all the people that they're helping. And you're welcome, of course, to reach out back to me as well if you have questions. So Jimmy and Bob, I really want to thank you guys for doing this. You're providing a great service, not only to the families in St. Louis, but to all of our investors all across the country.
Thank you, Kim.
Thanks for having us on, Kim.
Appreciate it.
Thanks for watching this webinar with Jimmy, Bob, and Kim Butler. I appreciate you staying to the end. If you are interested in one of our bridge loan opportunities, please reach out to me personally at 314-799-2247, or go to our website, jointopsproperties.com, and opt in. And when you leave your description or information, please let us know you watched this webinar from Kim and that you're a referral from Kim Butler. And I hope to speak to you in the future.